All right, so we're on learning objective 3 now of chapter 2. We are fixing to get some practice in recording transactions. But before we do that, I wanted to list the accounting process out for you. Right now, we only have 4 steps. When we get to chapter 3, it'll get extended a little bit, and then I won't touch it again after that. Okay. For right now, though, our 4 steps. First step, make journal entries, which we're about to learn how to do right now. We're going to post the journal entries to the ledger. If you think about the ledger, I need a better example, but I just think of like these old mafia movies that have these big giant books. If you think about one of those big giant books, and then each page has an account on it, like the first page might be cash, the next page might be accounts receivable, and then so on. Then the third step is to prepare a trial balance. And then the fourth step is to prepare the financial statements. Okay, let me write statements there because that's plural. We learned about the financial statements in the previous chapter. They are first one's income statement, statement of owner's equity, balance sheet, statement of cash flows. We're not going to have to prepare a statement of cash flows. Just know it's the fourth financial statement right now. Okay. Note, a trial balance is not a financial statement. Financial statements, outside people can see the financial statements. Pretty much only people that are going to see the trial balance is on the inside. Okay. It's not a financial statement. All right. So let's dive into making journal entries. So first of all, we do have some source documents, invoices that come, and some of this evidence is usually electronic these days. It's not so much by the mail or in paper form. Okay. But these documents do help us record transactions, have a paper trail on some things that we really need in case we get audited, or not in case we get audited. When the auditor comes in, if they ask about it, then we can pull those source documents and tell them what it was for. Okay. So I'm going to jump on down here. Um, Posting is really just moving the journal entry over to the ledger. We'll get to that here in just a second. They give us all of this information to make a journal entry. It's not as complicated as 5 steps here. Identify the accounts and the account types, asset, liability, equity. Determine whether there are increases or decreases. Follow the debit and credit rules. Record the transaction in the journal. Post it to the ledger. And then determine whether your accounting equation is in balance. Okay. We are going back to all those entries that we just made in chapter 1. Okay. All of these came from that. So these should be very familiar. Okay. I actually bumped over here and found where we made this entry right here, where the owner put $30,000 cash into the business and they gave her capital. Okay. We weren't making journal entries here, but we're doing almost the exact same thing. We are just adding the debit and credit element to it. Okay. So November 1st, Smart Touch Learning received $30,000 from Sheena Bright, and the business issued capital to her. We know from that previous one that we increased cash by 30,000, right? And we also increased her capital account by 30,000. Okay. So we have to do journal entries now because we're not going to be able to do a spreadsheet big enough to make every entry that a business needs. Okay. Journal entry is going to have the date. It'll have November the 1st. It's just a habit. I worked for an old school accountant. I always put the debit first, but that's just me. You don't have to. Computer systems could care less whether you put the debit in or the credit in first. Okay. So we'll have our cash account. We're going to debit that cash account for 30,000. Just to make it simple, 30K. Just kind of, I know you're not turning anything on paper for me, but I just draw a little line there. That way you can see the difference between the debits and the credits. And then we're going to credit SB Capital for 30,000. That is a journal entry right there. Okay. It's a lot nicer form right here to what they have. This little indentation for the credit is almost non-existent. If I was teaching accounting 40, 50 years ago, that would probably be very important because everything was on paper. Like I said, the computer systems do not care whether you put the debit or the credit in first. You're not going to have an opportunity to indent it. I just do it because I worked for an old school accountant as I was going to college. And so it's just habit. Okay. I think my accounting lab might make you put the debits in first, but you know, there's really no indentation that needs to be done, even if it is in there. It doesn't matter. Okay. So this is the journal entry. This is our step one. They are giving us the step one and step two kind of together here. Okay. So here's our journal entry. We've made that journal entry. If you think about a T account for each one of these accounts, so now they have this little T account here for cash. They're posting the cash to the cash account. And we're going to think about our T accounts as our ledger for everything that involves cash. Okay. And then they're going to post that Sheena Bright Capital, that's a credit to her capital account. Okay. Do you see how the debit is not good nor bad? It is just left right. Okay. That is very important for you to get. We did this right here in the previous chapter. We already did that. Okay. So those entries that we've already went through, that's why I like that they use the exact same problem because we've already done that under transaction analysis. Now we're learning to make journal entries. Okay. So now let's do number two. Number two, we purchased some land for cash. So cash went down of 20,000 and land went up. Okay. So I'm going to come over here and make the journal entry. I don't really have to, but I think it's good for you to see. Land is an asset. Land is going up, so land will be debited for the 20K. And the account that will be credited is cash. That makes sense, right? Because cash is going down now. Okay. Remember in this transaction, total assets remain unchanged. Okay. Because we just traded one asset for another. Remember, it doesn't have to have one entry on this side of the equation, then another one over here. It can be both of them on this side or both of them over here on this side. Okay. It just has, the equation just has to balance. Okay. All right. So here they made the journal entry. A lot nicer form than I did, but I still think it's good for you to see it. They're posting this to these ledger accounts now. Here's our cash T account. There's our November 1st where cash came in. November 2nd, cash went out because we bought some land. Okay. And then we have the new land account that has $20,000 in it. Okay. We did this right here in chapter one. Okay. Each one of those accounts, if you think about a T account for each one of those accounts, it will have those balances in there. Okay. Let's go through these a tiny bit faster because I know we're baby stepping in the shallow water of debits and credits here. Okay. We purchased some office supplies on account. Cash was not involved. Okay. So it says Smart Touch Learning buys $500 of office supplies on account on November the 3rd. Cash was not involved. We can we can mark that out. That's not going to be a guess. Okay. So we are going to debit office supplies for $500. That is my debit. And my credit will go to accounts payable because we bought it on credit. If we had bought it with cash, this would have been a credit to cash. Okay. But we bought it on credit, so it is going to accounts payable. Okay. In an entry like this, if you have no idea what you're doing, try to get one or the other. Okay. Try to get the office supplies, the debit, because you know office supplies are going up. Sometimes you can reason out, okay, I need a credit. What? And go back and look at those debit and credit rules and say, hey, what do I need a credit? What could be a credit? Okay. All right. So there's the journal entry. I showed it to you before I did it. And then notice they're posting it to these ledger accounts. Okay. Next one, transaction 4, earning service revenue for cash. So on November the 8th, Smart Touch Learning collected cash of $5,500 for service revenue that the business earned by providing e-learning services for clients. They collected cash. We know cash went up. Okay. Cash is going to be a debit of 5,500. What do you think my credit would be? Okay. Debit and credit rules. Let me jump over here really quick. Kind of sounds like revenue, right? Okay. They performed a service, so we are going to credit service revenue. Okay. Okay. They went ahead and posted these. Notice our cash. We're keeping up with our cash and how much cash we have. In a computerized system, this step and this step, that's step 1 and 2, make the journal entry and post it to the ledger. Those actually happen simultaneously because a computer can do it like that. Okay, let's go to the next one. Transaction 5, earning some revenue on account. Okay, we're earning some more revenue, very similar to the previous transaction. We're going to date it November the 10th, but they didn't get cash. They said the clients will pay us at a later date. So let's figure out the credit first. The credit is going to be easy on this. So we're going to credit service revenue for 3,000. What account do you think we will debit for that 3,000? If you said accounts receivable, you were correct. Okay. Remember accounts receivable, they extended credit to the customer. They did all the work and sent the work to the client. Revenue has been earned. It does not matter that we haven't gotten it in cash yet. We have earned revenue. We now have a promise for that client to pay us in the future $3,000. Okay. Okay. And you can see the journal entry looks a lot better than me writing it, but I think it's good for y'all to watch the process. Okay. Didn't involve cash. Okay. Try to figure out, did it involve cash? Did cash go up? Did cash go down? Or is cash even involved? Okay. This transaction, no cash was involved. Okay. So now let's go to transaction 6, payment of expenses with cash. We're paying for expenses with cash now. Okay. So we are going to date this the 15th, and cash is going to be going out for the total of all of these, but we are going to debit some expenses. Okay. We have office rent expense and we have salaries expense. So we will debit rent expense for 2,000. I don't really like them making a compound entry here, but it is what it is. Okay. Because you're probably going to write one check. It looks like we're writing one check here, and we're probably not paying the rent to the same people that are our employees. Okay. And we're going to credit cash for 3,200. Okay. I would have done those in two separate entries, and I think I said that in chapter 1 as well. But for simplicity, notice our debits equal our credits. I said at least two accounts, so it can be more than two, but it has to be at least two accounts. All right. And they are posting this to rent expense, debiting the rent expense, debiting the salary expense, and crediting cash right there. Okay. Transaction number 7, payment on account. So I just gave you the information. Let's do this. November the 21st, Smart Touch Learning paid. Anytime you see paid, cash left the building. Okay. So we know we will debit cash for 300. And it said from the accounts payable created in transaction number 3. Okay. We are going to debit the accounts payable. Okay. Back up here, right here, we bought these supplies on credit. So we credited accounts payable for $500. That's all we're doing. They did it right here. I am going to bring this down to that transaction where we just paid it. Okay. We debited the accounts payable because we're making it go down. Okay. If we look at our debit and credit rules, if we want to decrease that liability, we are going to debit it. Okay. They don't ask us just yet, but we could draw a line. Anytime I draw a line at the bottom of the T account, that just means total. And there would only be $200 that we owed them. Okay. And we have to be very careful and make these transactions correct. Because just think about that. If that's a vendor that sent you cash or that you sent cash to, you would want to make sure they marked it out that you paid that off that bill. Okay. So this would be the ledger. And they actually had it right here. We had the credit of $500 and then the debit of 300 left us a balance of 200. We'll see that here in the next few entries, okay? All right. Then we collected $2,000 of cash from that client, okay? So if we look at the 22nd, we're getting cash. We collected cash. We are going to debit cash because we're making the cash go up. And we got to have a credit to balance it out. That will be accounts receivable because that customer, we extended credit to that customer and now they've paid us part of that money. Okay. So we have to make sure we mark it and we know that customer paid us how much they've owed us. Okay. So debiting cash because we're increasing it, credit accounts receivable because we're decreasing it. These are two assets. This is a journal entry where they love to trick you. They may say in a multiple choice question, they may say, hey, after this transaction, how did total assets change? 0. You had an asset of cash that came in, exchanged for another asset of $2,000. Assets remained unchanged after this transaction. Okay. You can see the cash, how they're continually keeping up with that cash in that T account. Okay. I believe this is close to the last one. This is where the owner took $5,000 cash out. So we know we're going to credit cash because cash is leaving and we're going to debit the withdrawal account. I'm going to jump over here. That makes sense because to debit the withdrawal account is how we're going to increase the withdrawal account, but it will ultimately decrease total owner's equity. Okay. We credited cash because cash was going down. Okay. So now they have all those entries in cash. And when you're doing these problems and you draw a T account out for cash, leave yourself lots of room because there's usually lots of entries for cash. Okay. Oh, there was one more. All right. December 1st, Smart Touch Learning prepaids 3 months of office rent for $3,000. Cash left the building. We know we credited cash. We are debiting an asset called prepaid rent. Okay. In the next chapter, we're going to do adjusting entries. We will learn how to adjust these accounts down to match what they are actually worth. Okay. But again, this was one asset for another asset. So they might ask you, did total assets change? It did not. Okay. Oh, there's more. I did not realize this problem went on this long. All right, transaction 11, payment of expenses with cash. So we will debit salaries expense and credit cash. Okay. And then transaction 12, we are going to purchase a building with a notes payable. This won't involve cash. Okay. We are buying an asset building and we are going to finance that with a note payable, that is a liability of $60,000. Okay. We've got more. Transaction 13, the owner puts some money in the business. Sometimes that happens. Business might be low of funds and the owner has to kind of shore up. Hey, we need to put some more cash in there. So this is where the owner didn't put cash. The owner actually put an asset into the business, which is perfectly fine. Okay. She put an asset worth of furniture worth $18,000 that increased her capital account. So in the previous one, this was cash. It could be a building, it could be land, it could be some sort of patent or copyright, any kind of asset that'll provide the business with a future economic benefit. Then we can add that in. We have our asset increase, but then her capital account also increased. All right. We have an accrued liability here. On December 15th, Smart Touch Learning received a telephone bill of $100 that it will pay next month, but it's this month's phone bill. Okay. So we have to debit utilities expense and utilities payable on December 15th because that is a bill that is associated with this period of time for the accounting purposes. It doesn't really matter that cash is going to go out sometime later. Okay. All right. Then transaction 15, they are payment of an expense with cash. They are paying the employees $1,200. Remember, I think we accrued it back up there, didn't we? Maybe we did not. Okay. So payment of an expense with cash. So they had some more salaries expense, but they didn't credit salaries payable because they're paying it right now. And that's fine. So the cash is going to go out right now. Okay. I do know I'm going through these just a little bit faster. You can always pause the video and watch them again. Okay. Then on December 21st, a law firm engages Smart Touch Learning to provide e-learning services and agrees to pay $600 in advance. Okay. We're increasing cash by debiting cash. We are increasing a liability. Unearned revenue is a liability, not a revenue account. Okay. It's going in that. It's going to be held in there until they actually perform the service. And I think they're not providing any services until the next year. Okay. Or maybe they're going to earn it a little sooner. Sorry about that. I think this is our last one. Earning the service revenue for cash. Okay. So here they provided a service. It doesn't have anything to do with the unearned. They provided $8,000 of services and they got cash at the same time that they performed the service. So cash is going to go up of 8,000. Service revenue is also going up by $8,000. Okay. So I just want to flip over here. We're increasing cash. That makes that account go up and we're increasing revenue. Okay. So that's why we're crediting the revenue. Okay. Every one of these journal entries can relate back to those debit and credit rules. Okay. So here is the ledger where they have posted everything. It's kind of hard to see. But now there is a T account for every single account. Okay. So this would be the step two. Okay. And you can see they've made the cash big for us here. There is usually a lot of things that go into cash. Remember, adding all these things up, subtracting all of these things, and cash has a normal debit balance. If it ends up with a credit balance, I'd go back and check your numbers for the accounting classroom, but it could be a negative. It could turn negative. They had negative cash. But for the classroom, we usually don't see that very much. So if you end up with a credit on the cash side, then you might have added or subtracted wrong. So I'd go back and redo that. Okay. That's the T account form. They could do the ledger in this form. They call this a 4-column account, alternative T account. I like the T accounts. If you kind of think about right here, you could draw that T account, and that's everything right there. There's just in this, there's a balance after every one. This you would see more in a computerized system. Um, Doing it by hand, you're going to see this more. You're going to see the T accounts because they're a lot easier. That's a lot to draw out and get balances after every single transaction. Okay. We have posting references. These will refer, so you can see that was the very first entry that had a post reference of 101 because they recorded it in this account 101. And that credit of 30,000 went to account 301. We got those account numbers from that chart of accounts. Okay. That is all for this objective. I know that was a really long video and I do apologize, but I wanted to make sure all those transactions were in one video. I will see you in the next video.